When Apple wants to borrow money, it issues a bond. You as the investor buy the bond. Imagine now you're Apple and you short the box. Now you're issuing that bond as the borrower. Options, because they clear through the exchange, just like treasuries, they don't have the credit risk that you would typically see from the bond. So that's what makes it so pure.
Jeff Chang, thank you so much for joining us. Look, the Vest guys, we know you guys. You're the ones who sort of invented buffers, the largest player in the space. I don't want to talk about that. What I want to talk about is you've taken that options expertise and you've applied it to an entirely different line of business in loans. Let's walk through it. What are you actually offering to the investor and the advisor out there?
Yeah, great. So we actually, what's really exciting is our target financing platform that we've actually created through our first iteration being synthetic borrow. And I can tell you where it came from. So we use a lot of these strategies to borrow within the products that we build.
Right.
So that's where it came from. And it really stems from, in the institutional space, how are institutional investors borrowing in, let's say, the option market. So what we utilize is a option box, and option boxes trade every day on the exchange. And we're saying, like, why can't we bring that to financial advisors and their clients? Because the cool thing about options is there's interest embedded in options. Just like when you buy a stock, right? You get all the upside. But if you buy a call, you also get all the upside, but you didn't pay the full amount. So that interest inside is what we're trying to extract. So think about this. If I create an option box, it actually just behaves like a zero coupon bond, right? So let's say for 1 year, you have a zero coupon bond that's $96, appreciates to 100. So that $4 is your interest. So if you can issue that box, now imagine like if you invest in it, but what about if you went the other way and you shorted that box? Now you're borrowing at that rate.
So is it that easy to think of for an advisor? I think a lot of advisors have learned about box spreads, right? We've got a couple products trading that are giving you sort of box spread interest.
Yeah.
And there's some tax issues that it could be interesting there. Is this really just kind of the other side of the trade? This is who those people are giving the money to?
Exactly. So if you think about when Apple wants to borrow money, it issues a bond, right? And then when you as the investor buy the bond. So that's
Right.
what you're talking about.
Right.
Now, imagine now you're Apple and you short the box. Now you're issuing that bond as the borrower. Now, what's really interesting is this. The options, because they clear through the exchange, just like treasuries, they don't have the credit risk that you would typically see from the bond. So that's what makes it so pure, is that the interest rate is almost very close to
thing to credit risk is the options clearing corporation.
Yeah, exactly.
Right?
At very competitive rates. Now, if you put that in context of asset-based lending today, like pledge asset borrowing and margin, where they could be charging you anywhere from like SOFR +3, SOFR +4, right? Now think about if I could tell you today you could get like little over 4% borrowing rate. That's amazing, right?
Like T-bill, like
exactly,
T-bill,
exactly.
So is it really that straightforward that people are looking at, like, I have $500,000 in stock that I don't want to sell. Here are my options. I can pledge that to a bank or to Schwab or to somebody else. I'm probably going to pay about 10% now, or I'm going to probably going to pay about 8% now. Margin's running around 10, right? Roughly in the ballpark there.
Exactly.
And so you're talking about, hey, you could borrow at 4 to 5 instead of up in this 8 to 10 range, and you're not taking any additional risks by doing that.
Exactly, and it's actually much simpler than that. They don't even have to move it. So, like, let's say on their custodial platform, you see how much margin power you have. It's a separately managed account bolted on there, utilizing that margin to borrow. And that's what's exciting, is that all it is the same existing process that if they're already in other types of asset-based lending, it utilizes that same collateral where it can stay exactly where it is and offer these types of loans or short boxes that people can now borrow at rates in which institutions
are. Pretty much any asset that I would be custodying at Schwab, stocks, bonds, ETFs, mutual funds, anything I could stick over there.
Anything that you can that's marginable, and you can see that right on your, let's say, brokerage account.
Okay, great. Let's flip to the other side of it. Advisors, I know, are pretty conservative. I don't see a counterparty risk here unless you think the options clearing corporation's going under, which I'm going to die on that hill. So what are the risks here? Like, why are there any additional risks that the investor is taking, or additional hassle or restrictions that I might face versus, say, just taking the margin loan, which is sitting right there?
So the risks are going to be very similar to margin, pledged asset borrowing, other types of asset-based lending, right? Your security portfolio falls, you get a margin call. And that's actually going to be almost identical to those types of solutions. So it's the same risk that you would have. So obviously, a lot of our clients are already using asset-based lending, and they're using this as a alternative to say, hey, you know what, I can use that same margin power. Now, it's the same ease of setting up, let's say, a separately managed account where we're the sub-advisor and we help you trade those options.
Small little hurdle, just like if an advisor is going to bring in a new SMA into an account.
Exactly.
So there is an account creation step, which if you're just doing margin lending, maybe you don't have to do that.
Exactly.
So there's a tiny amount of hassle.
But what's really exciting is that in other asset-based lendings, there's a potential where it's not tax deductible, right? Like today, you're not able to tax deduct the interest that you pay in many cases on the asset-based.
Right.
Yeah, exactly. But in this case, we are shorting 4 sets of securities that is appreciating up, which is basically creating loss. And there's a potential where that is actually tax deductible as, let's say, capital loss carry forward or capital loss, which can carry forward forever. So then take that as a moment and think about if I'm like around a little over 4%, and I'm able to deduct, let's say, short-term capital loss against it. You're talking about sub 3% lending, right? Like, that's amazing, right?
Okay, I get that. The pushback with there might be that we are changing some of the depreciation and amortization rules about how businesses at least deal with the tax side. So that might be changing. But right now, for sure, I can see that there's a tax arbitrage.
For individuals that in their investment accounts, you're trading options in which you could potentially have the capital loss.
And at the moment, is this something you're just doing with Schwab?
Yeah, so it is currently available on the Schwab platform.
Okay, great. Jeff, thanks so much. Love the innovation.
See you again.
Cheers.